Hello, my name is Lee Presser. This is my show. I speak frequently to very interesting people. Some of these conversations are so exciting, so intellectually stimulating, I thought others might like to listen in. This is the reason we started recording Conversation with Lee Presser.
Welcome to Conversation with Lee Presser. The Federal Reserve System is America's central banking system. It was created in 1913 by Congress. The Federal Reserve Act was passed in response to a series of financial panics, especially the Panic of 1907. Today, the Fed's duties include conducting the nation's monetary policy, supervising and regulating banking institutions, maintaining the stability of the financial system, and providing federal services to depository institutions, the United States government, and official foreign institutions. Our guest today is Bill Emmons, an assistant vice president and economist at the St. Louis Reserve Bank. Mr. Emmons conducts research and policy analysis in the areas of banking, financial markets, and financial regulations. He's also an adjunct professor of finance at the John and Olin Business School at Washington University. Bill Emmons, welcome to Conversation.
Thanks, Lee.
This is your first time here, but we've known each other for a while.
That's right.
Well, I'm sure glad that after all this time to have you here and talking about the Federal Reserve, it's become a curiosity point among the public. At one time, I'll bet you'd talk about, oh, I'm with the Fed, they'd be like, what? You know, what's that? I bet some people were, what's that? Why don't you just, I know in the introduction I gave something of a description of the Fed, but you're an insider. You tell me, what does the Fed do for the American people?
Well, I think you summed it up pretty well. The central bank has, at a very broad level, the responsibility of maintaining financial stability and price stability.
What happens if you don't have financial and price stability?
Well, what I mean by financial stability is just that the banking system, the currency, payments, financial markets all work smoothly. And so it's one of those things that if we're doing our job, nobody knows we're doing it. And so the lack of financial stability or financial instability is when all of those things to do with money and finance, financial markets, banking, start to become a problem and get in the way of the ordinary course of business.
Well, how does a central bank do this essentially? I mean, what is it? What's the moment when the central bank has to step in and its operations saves the day?
Well, first of all, the central bank is the bank for the banking system.
Right.
We are the center of the banking system, sort of the fulcrum in a way. So when the private banking system and more broadly financial markets are functioning, we're doing a very routine kind of interactions with those parties. Mm-hmm. It's when problems start to arise in the banking system, in the financial markets, when the Fed expands its role, becomes, in some cases, the lender of last resort, when individual banks, or in some cases even financial markets, are unable to finance themselves normally. They can come to the central bank. And of course, during the financial crisis of 2008, 2009, the Fed's particular responsibilities or particular actions expanded far beyond what we'd seen for many, many years.
Now, I remember that during the Bush administration that the government authorized an additional $700 billion to be spent or put into circulation. What was that all about? Why would you do that?
Well, that's points out a distinction between the two, if you want to think about the two major economic functions of the government, fiscal policy and monetary policy.
Okay.
So the central bank is really the entity that operates monetary policy, all the things to do with money, banking, and finance. And the Congress undertakes fiscal policy. So what you talked about, whether it was the Troubled Asset Relief Program, the TARP, or the Economic Support Program, the stimulus, and then a whole array of other programs, that's fiscal policy, which is, in a nutshell, just all of the decisions made by Congress to spend money and then tax the citizens in order to pay for that.
Sometimes.
There were lots of changes. There were lots of changes in the tax code also.
Right. So, where did this $700, and I don't mean specifically, but in general, where did that $700 billion get out to?
Well, a lot of it went to state and local governments. A lot of it went to individuals. Some of it went to financial institutions.
Was this for their liquidity purposes? Like, were they, I guess what I'm asking, at that moment in 08, 09, did the banking system suddenly, like in earlier crises, find itself with a shortage of cash?
Well, that's another good distinction between illiquidity and insolvency. And those, I would say, line up somewhat similarly to the distinction between monetary policy and fiscal policy.
Okay,
If it's a matter of illiquidity in the financial system, that's the role of the central bank, of the Federal Reserve. If it's more a question of lack of solvency or lack of financial strength in the economy more generally, that could be addressed with fiscal policy. And that's what I think what you're referring to. Much of the stimulus money, the TARP money, was really focused on the financial strength or the solvency of broad parts of the economy, not just, in some cases, financial institutions, but other businesses and, of course, households, trying to strengthen people's, their own balance sheets and making them better able to survive the stresses they were facing.
Well, as I understand it, there were a number of banks who had loaned money to people, and that suddenly they found that, holy cow, these people weren't in a position to pay their loans. And so suddenly, and then they're supposed to take, and then they're supposed to pay people because you know they're expecting money, and then that money moves down the chain. But if they didn't get that, then all of a sudden they're like without, and so they can't pay their bills. Is that where some of that money went? Is so that those banks that were expecting to be paid by mortgage holders, in other words, people living in houses they couldn't afford to pay for, that's where the money went, so those banks didn't collapse?
There is an element of fiscal policy there, and you're exactly right to point out that our economy is so intricately interconnected that when there's a problem in one area, it can very easily spill over to other areas. So in the normal course of time, there are banks that, as you say, make loans that can't be collected in full. They lose money on securities, whatever it might be. And so they become insolvent, and so there is a sort of a normal course of affairs, which is we have the Federal Deposit Insurance Corporation, the FDIC, which comes in and takes over failed banks when they become insolvent, and then either the remains of that institution, the loans and the deposits and the facilities, et cetera, are either sold to another bank, or in some cases, and this is fairly rare, those assets could be liquidated and the deposits paid off.
And the bank just is gone.
And the bank charter would be revoked, and the institution would no longer exist. So that's, as I say, that's sort of, we have, and this is different in the United States than in many other countries where they have fewer banks, and it's not expected that banks will fail. In the United States, we do have, you know, you've heard this expression, the freedom to fail. And so it is expected that there will be some banks that go out of business in this way, and the FDIC is then the mechanism that we use, or the resolution mechanisms that the FDIC has in place. There are often, almost always, losses incurred, and that's paid for by a deposit insurance fund, which was replenished by fees or deposit insurance premiums that the banks pay.
And that's how this FDIC gets funded.
Yeah, it is designed to be a pre-funded reserve, like an insurance reserve. Now, in this last crisis, as well as in the early 90s, the failures came so fast and the losses were so large that the fund was depleted and went into a negative position.
What happened then?
Well, at that point, the Treasury then essentially is financing it temporarily until the premiums of the surviving banks can replenish that fund again. So it is designed to be, as I say, it is an insurance type arrangement so that it's primarily funded by the banks. Of course, there is value to the Treasury backstop, the full faith and credit of the U.S. government behind this fund gives confidence to people that their deposits will be covered no matter what happens to the bank. So as I say, that's the normal course of affairs. What was different in this severe crisis was that there were a lot of institutions, I'm thinking particularly of the very large institutions, that in some sense, or one sense, probably could have or should have gone through that resolution mechanism. It's reasonable to think that some of those banks were insolvent. And of course, there's a huge question in any crisis about what assets are worth. What is a loan or a security worth?
I don't think people recognize, especially like, let's say California. Somebody in 2007 or early 2008 buys a house, pays $750,000 for it,
right, because
that's what they think the value is. Suddenly, all of a sudden, they're told, "Oh no, the value of that property is really $500,000, and that $250,000 down money that you put in, that's all gone."
Right.
That's all gone, right? Isn't that essentially what we're talking
right.
about?
And you, as you say, we were talking about the distinction between illiquidity and insolvency, and there's this question of the value of an asset during normal market conditions and under stressed conditions, when there might be what's sometimes called an illiquidity discount. So an asset that you think, whether it's a house or a loan or anything else that you think has a certain value or roughly a certain value in normal conditions, under stressed conditions, you may not be able to get anything close to that. And so it's exactly the mechanisms of the deposit insurance, the Federal Reserve as the lender of last resort, that are designed to try to take the worry away from ordinary depositors that the illiquidity that could come in and cause the market value, marketable value of a bank's assets to go very low, that won't affect them. So it has, in fact, precluded bank runs, which just make the situation worse when people are trying to pull money out. And so we haven't had to face up to that illiquidity discount on a large scale before this crisis. And that, in a sense, is why this crisis was so different, was so severe, is that the illiquidity became so pervasive.
Lack of cash.
Lack of marketability is what I'm thinking.
Somebody has something that they want to sell, but nobody.
But the prices were so depressed that in many cases banks and other financial institutions didn't want to sell at such depressed prices. And that had the cumulative effect of sort of drying up credit. So there was just kind of this log jam. And I say it derives from the failure of markets to continue to function in the way that we normally expect they would. So the liquidity, the cash aspect of banking was not a problem because the Fed was there. We continued to lend through ordinary channels and in fact opened up new channels, new ways to get cash to banks. And then, as I said, in the crisis, actually beyond the traditional realm of the Fed, which is commercial banks and thrifts. And the Fed began to lend, for example, to primary dealers. This was at the time of the Bear Stearns collapse in early 2008. A new facility was opened up to provide discount window type short-term liquidity access to what we call the primary dealers, the securities dealers, which had previously not had direct access. As the crisis proceeded and got worse and worse, the Fed continued to open new facilities and made liquidity available to, for example, money market mutual funds, which they're not banks and they had not had access before. So the liquidity was not the problem in terms of the cash liquidity. It was the marketability, the prices, the illiquidity discount that assets were facing in markets.
It sounds like so many assets were overpriced, and then suddenly they returned to a normal level.
And of course, that's right. That's exactly right.
They had been run up.
How much of that, an asset, and I'm thinking of, for example, subprime mortgages that were bundled into securities that had been sold at 100 cents on the dollar. Now, owners of those securities were getting bids for 20 cents.
Because the property really wasn't worth 100 cents.
Well, that's the question. Was it really that they were now only worth 20 cents, or were they worth 60 cents? But nobody knew for sure what it was, and so in a panic, potential buyers just said, well, there's no reason to buy. I'm going to wait until things clear. But if that becomes pervasive, widespread, nobody is a buyer, of course, then the seller has to keep looking for a lower and lower price to try to move the asset. And we may get to this a little bit later, but that's what's happening in the housing market still today. We're now essentially 5 years into the housing market correction, and we're still struggling with a supply and demand problem. That there are certainly in areas that had, as you said, these huge run-ups, unjustifiably high prices. As those prices corrected, it started to cause fear and uncertainty that nobody knew exactly what the right price was, and so a natural reaction of buyers is to pull back and wait, wait for more clarity and certainty, and so that exacerbated and is still causing that problem.
I want to switch gears just a little bit here, and then we're just going to do a small segment here. Then we're going to go on to the article that you wrote, because I want to talk about that. But the question I want to ask right now has to do with why are so many political people and newspapers talking about the amount of debt the United States is carrying right now, as opposed to 10 years ago that you hardly ever heard anybody talking about this except esoterically.
Yeah, that's a good point, that if you look at the level of federal debt relative to GDP, the overall measure of the amount of output of goods and services, we've seen these numbers before. And I think the reason that it's so different, of course, as you know, there has been discussion for many years about getting the debt under control, but what's really made it acute is the trend, the direction. If you just look at the charts of where we think we're headed, it's very frightening. It just seems to be out of control.
Now, what is frightening to you as an economist?
Well, as you think about the trend, just for example, how much will it cost to pay the interest on the debt in 5 years or in 10 years if this trend continues of borrowing very, very large amounts year by year and accumulating year by year a larger and larger debt. As I say, we've already seen these numbers in our lifetimes, and that was after World War II. There was a tremendous increase in government borrowing to finance the war effort in the 1940s. That came down over decades and really hit a bottom. I'm thinking in terms of the scale of debt relative to the size of the economy, bottomed out in the 1980s. So it was a matter of 30, 40 years, and it wasn't so concerning because the trend was down. And that was a combination of things. The economy grew faster, we had productivity gains, we had huge increase in levels of education through the GI Bill and other things. We had population growth, and of course some inflation, which also tended to make the burden of the existing debt go down. Now come to the present day, and we do have still some growth, but population growth is much more subdued. We have an aging population as opposed to the baby boom era when we had a huge increase in the number of younger people. There's much less inflation, which is a positive in many respects, but at least in this one minor respect, it doesn't erode the debt as fast. So any given trend in the debt is a little bit more frightening with very low inflation, because that's a real burden that's going to hang around. And I think the key thing, though, is maybe two things. The rate of growth is just not as high. Rate of economic growth is not as high as it was back in the 1950s and 60s. And there's really not a lot of hope that we're going to get back to those very high rates anytime soon. And then, of course, the other is the level of deficits now on the order of 10% of GDP, which, and you've probably heard this expression, we have never seen this level of deficits outside of wartime. And of course you can say, well, this is a wartime, but it's not in the same sense.
World War II.
It's not an all-consuming. No. The economy back in the 1940s, everyone was focused on the war. The financing the war effort was, everybody, I think, or most everyone agreed, was necessary. There was a groundswell of support. So it wasn't. It was a necessity, not a choice. And I think today what's different is the feeling that the debt that we're running up is not due to a world war. It's not due to horrific bad luck or catastrophe like an earthquake and tsunami. It's choices that we've made. It's because of the problems that built up in the private economy. We've, in a sense, socialized a lot of that. We've transferred a lot of private debt transformed it into public debt through bailouts and other mechanisms. And that includes, of course, lower taxes. So we're not paying for the choices that we've made.
Well, okay. Yeah, I mean, I made the comment before, I just sort of blurted out, buy war bonds. But when I say that, actually what that means, as I understand what that means, is that don't spend money or don't spend wealth that you've created, save it, and then later on we're going to let you spend that, but we're going to save that wealth for right now. Which brings us to this article that you have written, in which I believe what you were saying there is that much of the wealth that America has accumulated over a long period of time has, since the 1980s, is being dissipated right now. And that's part of the problem. We are not creating enough wealth in order to sustain the kind of spending that we're doing.
I think that's right. If you think about, we'll just think about two major asset classes, which would be important for most people: stock market wealth and housing wealth. And we've had, in the last 30 years or so, unprecedented, or at least for many, many decades, huge increases in stock prices. Of course, we've had two major corrections in the early 2000s, and then again at the time of the most recent recession and financial crisis. And yet,
you're talking about the tech bubble.
Well, right.
So the tech bubble that crashed in 2000.
Yes, huge increase. And now, of course, much of the increase in stock market wealth in the 1980s and into the 1990s was returning to previous levels after stock prices had been very depressed in the 1970s due to inflation and OPEC oil shocks and all sorts of disruptions, political disruptions. So in a sense, the 1980s was a return to a more normal level of stock market valuations, but that boom just continued on and on. Now, some of it was probably justified by productivity increases, as you say, the tech boom. There was something real there, but we overdid it and reached a peak in about 2000 in terms of stock market valuations, which, certainly in retrospect, and I would say also at the time, seemed out of line with probably the sustainable level of profitability of companies and the growth of the potential of the economy. So there was, I think, and I will call it a correction in the early 2000s. But then we had another fairly strong run-up starting in about 2003, peaking in 2007 in the stock market. Again, a very significant 50+% decline in stock market values. And once again, we've had a nice, it's almost a doubling from the bottom in early 2009. So my point being, over this last 25 or 30 years, it's been very volatile, both on a day-to-day basis and certainly looking over these huge cycles, ups and downs and again up. But the net result has been that certainly for those who had large stock market holdings, it became very significant in terms of thinking about how much you want to spend, how much you want to borrow. But of course, thinking about the borrowing, the spur that stock market wealth provided to borrowing is nothing compared to what the housing boom did. And of course, these are very different asset classes in the sense that stock holdings are generally pretty concentrated among wealthier individuals and held by institutions on behalf of individuals. Housing is much more democratic, if you will. Roughly 2/3 of households own their own home, and roughly 2/3 of those homeowners have mortgage debt. So it's a very significant asset class in terms of its breadth. It's also, obviously a house is a substantial asset, so it's for many people, in fact I think this is true for most people, it is the largest single asset. And because it's part of your life cycle, people want to buy a house when they're relatively young so they can enjoy it, raise their family in that house. So it's very often associated with borrowing. So we have a very large asset with leverage, that is with debt, and increasingly in the 1990s, but especially into the 2000s, more and more it became part of the culture, I think, to expect that houses would rise in value. Not just a gentle rise about with inflation or a little bit more, which is what the historical evidence suggested, that houses appreciate on average just a little bit more than inflation. But there was this period of fairly strong increases, and of course we all read about the stories of California and Florida where you had double-digit increases, or Las Vegas, where at one time in Phoenix, house prices went up 50% in 1 year.
But the problem, as I see, and by the way, we've got about, about 4 minutes left to the end here. But the problem, as I see it, is that when people had these run-ups in the value, the perceived value of their property, where they got into trouble is that they borrowed against it, went out and spent that, in other words, liquidated their assets, and then suddenly when prices returned to where they actually should have been rather than up here, they're down here, that's why we had, why people are feeling so poor.
I think that's right, that if you look in the aggregate, as house prices went up, rather than banking that in terms of building up a larger equity cushion, to a first approximation, most of the gains were liquefied. So it wasn't that equity was falling,
but they dissipated their wealth.
Well, yeah, increased their debt.
Yeah.
And so, you know, there's no guarantee that house prices will stay at a certain level, and of course they didn't. And house prices, and again, at the peak or even before the peak, house prices did appear relatively high compared to people's incomes and certainly relative to historic appreciation rates.
We got about 2 minutes here, and I want to just ask a quick question. What do you think the next year, we're going to keep it really short here, what do you think the next year or two is going to look like in terms of the economic climate? With the debt rising the way that it is, with countries outside of the United States becoming very suspicious of whether the United States is capable of borrowing money from them and paying it back.
Maybe I don't have much imagination, but I think the next 12 months is going to look a lot like the last 12 months. And in fact, I think the next few years are going to look like the last year or two. It just seems to me that we're sort of stuck in this pattern of low growth, repeated fears of falling back into a very slow growth period or even recession. The political climate, I think, is very poor in terms of really getting ahead of these problems. I suspect we're going to have something like these confrontations about debt ceilings and budgets that will be ongoing. So, you know, I think it's better than, in some respects, better than a fall back into a severe recession. But on the other hand, there's every reason to expect that we're going to continue to have this kind of slow growth, very unsatisfactory, not solving anything, political debate for some time to come.
You and I have talked about this before, and I know we don't have time for this full-out discussion, but it seems to me that at the crisis moment in 08 and 09, had the government not stepped in, and there was the big fear that, oh my God, the whole thing would have fallen in. Okay, if we had let it fall in, would not this massive $14 trillion debt have been dissipated? And that that's what happens during depressions, is that property goes back to its rightful owners and debt's dissipated.
It's as you know,
30 seconds.
A fascinating hypothetical, and many people will be talking about this for many years. But if there had not been the massive intervention by the Fed and the federal government, fiscal and monetary policy, I think we would have had something that felt more like a depression. Some of the simulations that I've seen suggest 15 to 20% unemployment, and that would still be today. We would still be having 15% unemployment. We would have deflation. We would have had essentially most or all of the banks would have defaulted. They probably would have been nationalized. So it would have been a very severe downturn.
Right. Except we'd be out of debt. And we got to go.
Maybe.
I'm sorry. We've run out of time.
Yes.
Thank you very much for being with us today. I very much appreciate it. To my audience, I've been speaking with Bill Emmons. He's the Vice President at the St. Louis Federal Reserve Bank in downtown St. Louis. I hope you had a good time listening to this. For the rest of you, we'll see you next week. Thank you.